It will be, without doubt, the most radical tax reform package this country has seen.
Treasurer Paul Keating has announced the elimination of tax advantages gained through the negative gearing of rental properties.
That's going, saving the government a modest $140 million a year.
You were the most pragmatic politician that Canberra had seen in 10 years.
Well, that's what you thought, but you were wrong, weren't you?
In 1985, announcing an ambitious set of tax reforms, then Treasurer Paul Keating ended the tax break known as negative gearing, so people who owned investment properties could no longer offset their losses against their income tax. It wasn't to last.
In Sydney, rents for the average two-bedroom dwelling have increased in the last year by 17%.
2 years later, with rents spiking in some cities and the 87 budget and election looming, the government decided to cut its political losses and argued it had got enough from its other tax changes through to not bother with a fight over this one.
Among the main features expected to be announced tonight will be scrapping a government ban on negative gearing.
I believe that Australians will find considerable reason for joy.
I've never thought Mr Keating's pulled any rabbits out of the hat.
We are now in a position to permit the restoration of deductions against taxable income.
Fast forward 36 years, and negative gearing has once again come up in the political conversation in the wake of the federal government's move this week to cap tax concessions on earnings of superannuation accounts with balances over $3 million.
The savings that are made from the reduction in these tax breaks will contribute $900 million to the bottom line over the forward estimates, and some $2 billion when it is operating on a full year period.
The decision was announced after the annual release of estimates of what major tax breaks cost the budget. And, straight away, that raised the question of why the government wasn't doing anything to rein in tax breaks costing it even more than the super concessions. The estimates of the cost of tax concessions, contained in what is known as the tax expenditure statement, showed the biggest tax break of all is that the family home is exempt from capital gains tax. But no government in decades has been willing to even contemplate touching the tax status of the family home. And the Prime Minister made clear this week that wasn't going to change.
Can you rule it out?
Well, yes, we are not going to impact the family home.
Why not?
Full stop, exclamation mark. Because we're not going to.
But there are some other big costs to the budget in lost revenue, including $24 billion of tax deductions each year on rental properties. Getting rid of interest deductions on investment properties, that is, negative gearing, and other rental deductions is often discussed as an either-or proposition. But economists like the Grattan Institute's Danielle Wood say there is scope to cut back the size of the deductions.
There's a number of ways you could wind back that tax concession. You could say that you can continue to write off losses, but just not against wage income. You could cap the number of properties for which you can negatively gear. So it's certainly not often talked about that you would entirely abolish that, but you'd be looking at ways to wind it back and to better target it.
Billions of dollars that would otherwise be flowing into government coffers are also lost in tax breaks on capital gains on assets other than the family home.
So capital gains at the moment, people pay tax only on half the gains that they make. We would argue that that concession is too generous. Again, it's there to try and keep people's incentives to save, but it's gone well beyond where it needs to. So reducing that down, say, to 25%, would raise about $5 billion for the budget each and every year.
Beyond any loss of revenue to the budget, the fact that capital gains are not taxed as heavily as income has long been argued to distort investment decisions.
You create an incentive for people to borrow more, to debt finance their investments more heavily. You also create an incentive for them to come into markets like the housing market when things are running hot and capital gains are high. So you actually increase the volatility of housing price cycles as well.
Of course, the government insists it does not have any plans to make any further major changes to tax. But even without getting into the usual cyclical discussions about the need for tax reform, Most economists and budget watchers know that something is going to have to change, given the massive budget deficit and public debt interest bill. And politicians know this week's tax expenditure statement provides rich pickings for scare campaigns.
This is talking about $150 billion of taxes that could be up for grabs, including a tax on the family home, taxes on negative gearing and so on. If Labor can't be trusted on superannuation tax after making that commitment before the last election, how can we trust them on these other taxes as well?
What we know is that we've got an increasingly leaky income tax base. The tax expenditure statement that was released this week really highlights both the scale and the growth in tax concessions. And so governments will need to think about whether those concessions remain fit for policy purpose.
Which brings us to the elephant in the room, the so-called Stage 3 tax cuts, which loom closer every day before their introduction in the middle of next year.
They wipe about $20 billion a year off government revenues, and they were conceived in a really different time, in a time when we thought we were going to be running pretty healthy budget surpluses at this point. So we think they are too generous.
While the Prime Minister has been at pains to play down further tax changes, he has ramped up his message that the government will need to be less generous in future.
Australians who are having to make tough decisions around the kitchen table expect their government to be prepared to make tough decisions around the cabinet table.